Good morning and welcome everyone to this webinar where we will go through the prospects of emerging markets going forward. It's been an incredibly strong start to the year for emerging markets, the strongest in almost 10 years. And we believe that there could be continued tailwinds. We'll go through that today. With this weekend in mind, we couldn't have timed this much better. It was a very active weekend when it comes to headlines between the US and China. We were not supposed to start there, but we can't avoid it now. So yeah, Anders, I mean, it was with me today. Sorry, I have to say as well, we have Anders Borg, former Minister of Finance in Sweden and a senior advisor at East Capital, and also chairman of LKAB, which is one of the mining giants in Europe. Very timely with this weekend's discussions as well. So yeah, this weekend we had a major showdown between the US and China. To me, it's becoming increasingly clear that their dependency is more codependent, it's more balanced, the relationship. There will need to be compromises going forward. We had Chinese trade data coming out earlier this week, which show that US exports are already down 27% this year, but despite that, total exports are up 8%. So they have, in a very effective manner, been able to divert and redirect these exports, showing that they might not be as dependent of exports to one single country as earlier thought. And perhaps these tariff threats are less effective than they used to be. So Anders, what is your base case when it comes to the US and China? Will we see an escalation or will this likely just de-escalate and we will see progress in the talks that are expected to happen later this month?
Well, I do think we should stick to the view that tariffs haven't disrupted the global economy. In general, we see that the impact from tariffs on inflation in the US has been fairly benign. And I think it's the most likely outcome is that China and the US will find an agreement to take on rare earth metal as the tool or instrument of this conflict. I think is not very strategic from China, because that would unite US with Europe, the rest of the advanced economies and basically the rest of the world economy. So that's probably one of the few steps that China could take that would actually unite everybody against them. So therefore, I don't think they will use this. It's very important to note that China are now de-risking their dependence on the US. If you do an outlook for end of 26, the share of Chinese export going to the US is likely to be roughly between 5 and 7.5% of the total export. And if you take the medium-term perspective, this implies that China has taken out the dependence on United States with fairly low growth in the medium term, while substituting that for the rest of Asia, South Asia, Southeast Asia, where growth is higher. So if you do a GDP-weighted outlook for Chinese export growth, this will imply roughly a percentage point higher long-term export growth for China. So I don't think China will push this to a very deep conflict, and therefore I think there will be some type of agreement. I think we're not going to see the world economy being disrupted by tariffs.
Thank you very much, Anders. There was actually very interesting data about the future outlook for Chinese exports to these other markets as well. So when it comes to trade and trade tensions, there are two conflicts that are brewing still. It is the US and then it is India. India surprised most people a little bit more than the Chinese conflict, but nonetheless, it still exists. There's still a discussion between the US and India, which has pushed India closer to China. Do you believe that there is any long-term prospects of this renewed relationship between India and China, or do you think that they're simply using this to get the US to compromise a little bit more, not to lose India to China, basically, with a trade deal around the corner?
Yeah, I do think there will be a trade deal between India and US, and I think the tariffs will come down from these excessively high levels. Trump opened up now for some type of compromise where he argued that India has agreed to reduce some of the import of Russian oil. But in the longer run, I don't see India and China moving closer. We still have the difficult border issue with the contact line where we don't really have a recognized border. There is the issue of Tibet that is a big historical impact. So I think India will not be a close ally to China in any foreseeable future, but that doesn't imply that India will be in a US-European camp. India is a 1.4 billion people with a 5,000-year history and with a fairly troubled relationship with the US, if you look over the last, since independent, really. And the overtures that Trump has done to Pakistan hasn't really helped either. So India will be a major global economy. If you take a 10-year perspective, they will add another Germany in nominal GDP. If you take a 20-year perspective, it's going to be one of the biggest economies in the global economy. So obviously they will put their own interests first, and obviously that outlook is dependent on the fact that India sticks to a good economic policy.
So they will continue to do what they've always done, what's best for India, basically.
Which they should.
Yeah, absolutely. I agree. With that in mind, I mean, if you look at India, for example, I mean, fundamentally, it hasn't been a bad year for India. It's actually improved on pretty much all fronts since this year started. I mean, last year when we saw India starting to slide, it was because the economy was slowing down. Now we're actually seeing the opposite. It's re-accelerating again. So if we see a resolution or to these trade tensions, then we should probably see the next trigger for India as well and see better markets ahead. With that in mind, Anders, so what's your view on this growth, inflation, interest rates, and prospects for these markets going forward?
Well, I do think that we're in a pretty decent place. In the IMF forecast, we're seeing a US economy stabilizing, tariff impact on inflation being small, Fed cutting rates. So we're going to be in a period now for 2-3 quarters where central banks have a window of opportunity to reduce monetary interest rates. Europe is in a stagnation. That's as it is. It won't change, but it's a much more optimistic picture if you look at Northern Europe, the Nordics and Central Eastern Europe in particularly. Growth at 2% or above, very strong public finances, current account surpluses, low inflation. And if you also add the strength that we see in Asia, I mean, it's remarkable to see that China, India, the rest of Asia, all of these countries it's actually 4.1 billion people growing more than 4% this year. And what is kind of interesting is also that Asia has very strong macroeconomic fundamentals. If you look at current accounts, inflation, public indebtedness, and so forth. So the old view that the emerging market, particularly Asia, has a kind of a macro risk, I think I mean, we have to leave that behind. It looks like a strong growth with strong fundamentals in basically all the Asian countries.
Thank you very much for that. That's a good picture to have with us when it comes to growth. In particular, one sector has driven the markets this year, or one theme, and that's AI. And that's not something that is leaving Asia behind either, because they're very central in this whole AI race. It's been led by US mega cap investments. Do you think that this can continue, or have we gotten ahead of ourselves a little bit when it comes to the whole AI space?
Well, I think we are now going to see the benefits in terms of the return on the investments done. If you take the last 2 years, this year and last year, we're close to $700 billion in capex. If you include next year, we are hitting $1 trillion in AI investments. If these companies can only produce their own average margins, if you take a forward look then on the earnings, they are creating a $10 trillion shareholder value. If you accumulate it and use the let's say the Morgan Stanley more optimistic margins on AI, then we're talking 15 trillion. So the AI companies in the US could add roughly another European stock market. But I think it's very important to see that China is really coming on AI. DeepSeek was a transformational moment in terms of AI adoption. I think it's pretty clear that China is number 2 or even number 1 in some areas compared to the US, and very well ahead of Europe. One should also note that India is also on the same trajectory. There is if you look at usage on ChatGPT, India is one of the major countries. So AI, I think, will drive the markets. And I think if you compare it back to the 2000, we talk about the internet bubble. But I mean, then you had PEs that were roughly 50. If you exclude Tesla, the Mag 7 is actually at 25. If you compare it to back in the days, they have huge cash loads. They have very low indebtedness, and the underlying margins are at least twice as big as they were back in the internet days. So I think AI still has a room to go, and I do think that this potentially could also mean higher productivity. We see the US now adding another year of 2% productivity. Average productivity since 18 has now been 2%. That should spread to the rest, probably first to China, where adoption is very strong, but eventually also to Europe and the rest of the world. So I think we're in a period where you could see productivity lifting growth in a very sound and balanced way.
Jacob spoke a lot about that after DeepSeek, how quickly they implemented DeepSeek into the Chinese economy. They don't need to have all of the approvals and testing before applying it, basically. Something that shouldn't be forgotten is also the AI infrastructure. We're talking about chips, we're talking about these data centers and batteries, everything. And that's also a part of the value chain that is predominantly in Asia. You have Taiwan, South Korea seeing strong tailwinds this year from that theme, but also China. And it's interesting to hear you say that they are actually head to head with the US, basically, maybe slightly behind in AI, but not 10 years behind as people thought ahead before this year started. So looking at, the technological advancements we've seen in China, South Korea, and Taiwan, do you think that they can compete on a longer term basis with the US? Will all of this infrastructure and the technology and innovation stay in Asia? And will we continue to see this going forward?
If you list 10, 15 of the most important growth technologies going forward, it could be EVs, it could be batteries, it can be renewables, it can be AI, it can be biotech, it could be humanoids, or whatever one you choose. It's pretty clear that Asia is either close to the US or ahead of the US. On humanoids, I think it's pretty clear that the Chinese are taking the lead, as they've already done on batteries and EVs, renewables, solar, etc. The US is obviously very dynamic and very entrepreneurial, so I'm not worried that the US will lose out. But what is really worrying is that Europe is almost on all of these technologies well behind the US and China. And for Europe, if you look at creative destruction, there is always a price to pay for entrepreneurship and growth, and that is that legacy industries will come into decline. And Europe is actually the leader on almost all the legacy industries. So yeah, I think the technology shift we are seeing is going to be very beneficial for emerging markets.
Yeah, I totally agree with you. I'm also a little bit worried, unfortunately, about Europe when it comes to cars, everything, that China is clearly taking over. But are we focusing too much on the growth? When we talk about emerging markets, we talk, is China growing 4.6 or 4.8%, instead of talking about all of this innovation that will drive growth going forward, especially corporate earnings growth, which is perhaps more important as an investor. Are we focusing too much on growth and too little on the innovation that is taking place in Asia as a Western asset manager?
Well, I think the growth is fundamentally very important. If you look at nominal GDP in Asia, take India, for example, it's fairly likely that we're going to see 10% nominal growth. That implies that overall net sales in the stock market can grow 10, 12, 13%. The numbers for China will not be that high because inflation is very low and growth is lower, but in general you will have very strong support for net sales in almost all the Asian markets. And if you have decent profit margins, companies can actually produce a lot of shareholder value. And what is interesting with the portfolio that East Capital is running is that you can actually get these fairly good growth numbers and fairly good profit margins at the valuation that is substantially below what you would pay in the US or Europe for a company with the same metrics. If you have 20% EBIT margins and 10-15% growth, that would be a very expensive company in Europe. But you could find quite a lot of those in Asia at around a PE of 10 or even below in some cases.
Yeah, one shouldn't forget that the strength in Europe this year has actually led to higher valuation because it hasn't been driven by growth.
Yeah, and I think it's also very important to note that Asia has a savings culture.
Yeah.
So people are saving a lot of money. And when the financial markets have now opened in China, retail investors are coming in. In India, the markets have always been open. So clearly people can channel their savings for pension and security and all of this into the stock market. So with high saving rates and a growing willingness to invest in the stock market, I think that's pretty important for flows.
Absolutely. I mean, we've seen headlines in the last couple of months about record high gold savings in India and account savings as well in China. Moving on a little bit, I mentioned briefly at the start that you also work for LKAB as the chairman, the Swedish mining giant that knows a lot about rare earth minerals and metals. This has been a key question this week after China at least open to restricting foreign access to their metals. They hold the supply chain in an iron grip, controlling 60-70% of mining and 90% of refining. How long would it take for us in the West to build our own supply chains, or can we even do it?
Yeah, we could absolutely do that, and LKAB has already taken a decision to build a demo on concentrating apatite with fairly high degrees of rare earth metals. There is quite a lot of these projects. If China would behave like OPEC did in the 70s, then I think it will be a bit of turmoil, and then I think the alternative mines will be developed fairly rapidly in such a crisis scenario. So therefore, it's kind of a one-off chance for China, but the cost for that would be that we would see them as a major enemy towards trade and economic stability. And I don't think China wants to be in that position. They want to keep a dominant position in rare earth, which implies that they have to behave in a balanced and responsible way. Otherwise, we don't have an alternative to really front run and put a lot of heavy capex into doing this in a very short time period. So Europe, US, Africa, Latin America, Central Eastern Europe, there is a lot of rare earth deposits that could be mined. So I think the dependency on China will be reduced. The reason that they are dominant is that they have sold these rare earth metals at a very, very low price and thereby preventing investments. If they would change that behavior and start to raise the prices or diminished supply, then I think we would see a massive investment in the short run. So yeah, it can't happen in 3 months, but definitely in 12 or 15 months.
Okay, that is fantastic to know that it's that quick at least. Some were worried that it would take 5-7 years even for the West. So
no, I think that the main issue in the West is the permitting periods.
Yeah.
And if you would be in a deep crisis, I think the permitting would go away, and then you would develop the lithium assets in the US or the rare earth metals in the Nordics and so forth in a very forced way.
And I would guess that China knows this as well, so no reason to escalate and remove the world's dependency on them. They want to control these supply chains. So yeah, very, very good news, Anders, to hear about that. We spoke about this briefly, so I'll skip Europe. You mentioned already you see growth in Nordics, you see growth in Central Europe, not as much in continental Europe. Moving ahead a little bit, I know you don't like to take bets on currencies, but the market is betting on a weaker dollar going forward. So assuming a weaker dollar, which is typically positive for emerging markets, do you expect there to be continued tailwinds for emerging markets in the next 12-18 months? And also, many investors are underweighted emerging markets. Should they start looking more at Asia, or should they double down on Europe, as is the question going forward?
Well, I definitely think Asia has a much stronger medium-term outlook than basically any other place in the global economy. I mean, 4.1 billion people moving into a global middle class, that is going to be a massive impact on the world economy going forward. I don't think the dollar will dramatically weaken, because there is basically no currencies that needs to strengthen. The euro is in a weak growth period. Britain has a huge current account deficit. Japan is coming back a bit, but they definitely don't need a massive appreciation. And China is struggling with competitiveness and this transition out of US dependency. So they've had a bit of a depreciation that I think they are quite happy with. Stability against the dollar, but a weakness in trade-weighted terms. So yeah, I think that if you look at the DXY, it's very close to the average since 1975. And I think the prerequisite for emerging markets is just that the dollar remains fairly stable or softens a bit. And if you think that Fed is cutting rates to at least 3% or even slightly below that, which is my main scenario, I definitely think that the dollar is going to go sideways or weaken. And it doesn't have to weaken a lot because the fundamental drivers in Asia, I think, is pretty strong on its own.
Just not see a rally, mean reversion going back to.
Yeah, it's very difficult to see a dollar rally, I think, in this environment.
Yeah, that would not benefit their whole plan either with trade and everything. Thank you all for listening in. And if there is anything you would like to ask us afterwards, do reach out and we'll get back to you as soon as possible. Thank you very much.